Hi all, once again welcome back to FinaLit. In this video, we will be looking into the 5 most important corporate actions and their impact on stock prices. So, what is corporate actions? Corporate actions are initiatives taken by a corporate entity that bring in a change into its stock. A corporate action is initiated by the board of directors and approved by the company's shareholders. There are many types of corporate actions that an entity can choose to initiate. A good understanding of these corporate actions gives a clear picture of the company's financial health and also to determine whether to buy or sell a particular stock. Types of corporate actions: dividends, bonus issue, stock split, right issue, and buyback of shares. Dividends. Dividends are paid by the company to its shareholders to distribute its profits in the year on a per share basis. For example, company A declared a dividend of 42 rupees per share. Face value was 5 rupees. Hence, the dividend payout is said to be 840%. 42 divided by 5 multiplied by 100. Sometimes, if the company feels that instead of paying dividends, it is better to utilize the same cash to fund for a new project. The decision to pay dividend is taken in the annual general meeting. The dividends are not paid right after the announcement. The following timeline would help you understand the dividend cycle. Dividend declaration date. This is the date on which the annual general meeting takes place and the company's board approves the dividend issue. Ex-dividend date. It is normally set to business days before the record date. Only shareholders who own the shares before the ex-dividend date are entitled to the dividend. In India, the normal settlement is on T+2 working days basis. Stock price falls when dividends paid. For example, if the company A's share price is 335 rupees and has declared a dividend of 5 rupees, the price of company A will drop down to 330 rupees. Record date. This is the date on which the company decides to review the shareholders register to list down all the eligible shareholders for the dividend. Usually, the time difference between the dividend declaration date and record date is at least 30 days. Dividend payout date. This is the day on which the dividends are paid out to shareholders listed in the register of the company. Bonus issue. The bonus issue is a stock dividend allotted by the company to reward the shareholders. The bonus shares are issued out of reserves of the company. These are free shares that the shareholders receive against shares that they currently hold. These allotments typically come in a fixed ratio such as 1:1, 2:1, 3:1, etc. If the ratio is 2:1, the existing shareholders get 2 additional shares for every 1 share they hold at no additional cost. The number of shares the shareholder holds will increase, but the overall value of investment will remain the same. When the price per share of a company is very high and it becomes tough for new investors to buy shares. By issuing bonus shares, the number of outstanding shares increases, but the value of each share reduces as shown in the example. Similar to the dividend issue, there is a bonus announcement date, ex-bonus date, and record dates are available. Stock split. When a stock split is declared by the company, the number of shares held increases, but the investment value or market capitalization remains the same, similar to bonus issue. The stock is split with reference to the face value. Suppose the stock's face value is 10 rupees and there is a 1:1 stock split, then the face value will be changed into 5 rupees. If you owned 100 shares before split, you would now own 200 shares after the split. Similar to bonus issue, stock split is usually to encourage more retail participation by reducing the value per share. Rights issue. The idea behind rights issue is to raise fresh capital. Instead of going public, the company approaches their existing shareholders with the rights issue as a second IPO. The shareholders can subscribe to the rights issue in the proportion of their shareholding. For example, 1:4 rights issue means for every 4 shares a shareholder owns, he can subscribe to 1 additional share. The new shares under the rights issue will be issued at a lower price than current market price. If the market price is below the subscription price or rights issue price, it is obviously cheaper to buy it from the open market. Buyback of shares. A buyback can be seen as a method for a company to invest in itself by buying shares from other investors in the market. Buybacks reduce the number of shares outstanding in the market. However, buyback of shares is an important method of corporate restructuring. There could be many reasons why corporates choose to buy back shares. Improve the profitability on a per share basis, to consolidate their stake in the company, to prevent other companies from taking over, to show the confidence of the promoters about their company, to support the share price from declining in the markets, etc. When a company announces a buyback, it signals the company's confidence about itself. Hence, this is usually a positive for the share price. Recap. corporate actions has an impact on stock prices. There are 5 most important corporate actions. They are dividends, bonus issue, stock split, rights issue, and payback of shares. Dividends are means of rewarding the shareholders. Dividend is announced as a percentage of face value. If you aspire to get the dividend, you need to own the stock before the ex-dividend date. A bonus issue is a form of stock dividend. This is the company's way of rewarding the shareholders with additional shares. A stock split is done based on the face value. The face value and the stock price changes in proportion to the change in the face value. Rights issue is way through which the company raises fresh capital from the existing shareholders. Subscribe to it only if you think it makes sense. Buyback signals a positive outlook of the promoters. This also conveys to the shareholders that the promoters are optimistic of the company's prospects. Thank you for watching. If you really like this video, please subscribe, like, share and comment.